Welcome to today's webinar, courtesy of the Kentucky Small Business Development Center in Louisville. Discover no-cost, valuable business services to help you thrive, whether starting your entrepreneurial journey or scaling your existing business. We have the resources and expertise to help you succeed. For more information, please visit our website or text 502-977-5800. Thank you for joining us today. Feel free to use the chat feature to ask questions or engage with our speaker. Let's get started.
Hey, welcome everyone. I'm Dave Etkin, the director here at Louisville Small Business Development Center. Welcome to another Toolkit Tuesday. And if you're joining us for the first time, Toolkit Tuesday is our weekly one-hour webinar where we bring in the experts and other entrepreneurs and specialists who can help you sharpen your skills. Every week we kind of dig into something practical, marketing, finance, whatever we can come up with. We want to make it, find the stuff that really makes a big difference in your business. So just another quick note about who we are and what we do. I know you've heard it on the video, but let's just talk a little bit more. The Kentucky Small Business Development Center program is part of a national network that's been around for 40, 50 years. We're funded in part by the U.S. Small Business Administration, University of Kentucky, and a lot of regional partners, which means everything that we do here is no cost to you and is designed specifically for small business owners like you. So here in Louisville, our team focuses on helping entrepreneurs start, grow, and scale their businesses. We work with everyone from first-time founders trying to get their idea off the ground to established business owners looking to expand and access capital. So thanks again for joining us today. Just to make sure that everything's working and you can hear us. If you look at the bottom of your screen there's a little toolbar. It should pop up, and there you'll see the chat feature. If you wouldn't mind just saying hello and putting your name and tell us where you're joining from in the chat there. And as always, I'm joined with my good friend and coworker, Janet Flaw. Hey, Janet.
Hi, Dave. How are you doing today?
Good.
Good. Guess what today is?
Toolkit Tuesday.
Toolkit Tuesday, but it's also you're the expert today. So we're going to hear from you today.
That's right. Also means we couldn't find an expert, so here I am. So, all right, people are popping in. Hey, Jim. Gosh, I got you on my list still. So, yeah, good to see you, though. Thanks for joining every week. I really appreciate it. Hey, hi from Louisville. Amanda from Louisville. Good to see you. Thanks for joining. There's Meg. Lisa from Bardstown. Lexington. Hey, Ruth. Hey, Katie. Katie's with our SBDC staff in Maria. There's Jennifer. Hey, Jen. Ready to do your 26 budget. All right. Excellent.
Hey, you missed Leslie. She's from Portsmouth, Ohio today.
Oh, gosh. Well, my little thing's scrolling really fast.
Yeah.
Here. Okay. So she gets the distance award today. Congratulations, Leslie. So, all right. Well, thanks for joining, everybody. And as we kind of go through this today, if you will, have any questions, be watching the chat. We'll just, we'll kind of have a little dialogue as we go through here, because this is a pretty weighty, it's not really a weighty subject. It's fairly easy, but now's the time of year, October, November, really start thinking about, reviewing your budget, reviewing what happened over the last few months and the early part of the year. So I have kind of a particular way I do it that I want to share with you guys. So let's dive in and get rolling here. I'm going to share my screen. There we go. All right. How are we doing, Janet?
All right. Perfect.
Okay. All right. All right. Budgeting 101, building a budget in 8 simple steps. So, you guys see me every week. I'm Dave Eck. I'm the director here at this Louisville Small Business Development Center. Had tons of experience launching and buying and selling businesses and concepts, different business concepts. So here to help, just like everybody else. We're all seasoned entrepreneurs, and we just want to give back to the community and to you guys. I particularly took advantage of the Small Business Development Center program early on in my career. Always found it helpful, and when the opportunity for me to circle back around and get involved, I certainly did so. So here's what we're going to talk about today. Something that doesn't really happen a lot, but determining the right format for your financial information. That's something that I found super helpful. I want to share a little bit about that for you. And then this, what I call the bottom-up budgeting process. So it's a little bit different, and it's pretty easy. And I've got some tools I'm going to show that to you. And it only takes 8 steps to do this. And then at the end, we'll kind of share some spreadsheets with you when we push everything out, and you guys can do this on your own. So why do you need a budget? It's actually the most important tool in your toolbox. You know, the process is more important than the output. It is, you know, just going through the process really helps you prepare for the upcoming year, and more importantly, as your business goes along year after year and it grows and you're trying different things. You know, you're an entrepreneur, you're doing different things, trying this or that. You know, what you're putting together is a business model when you're planning these things. So it's really important to test that model on paper in a budget. It's also the roadmap for your business for the upcoming year. And most importantly, too, it is a benchmark to measure your performance. It gives you an alarm, like if you're off budget a lot. It'll help you stay on track. So everybody's popped in the chat. Oh, I see Estella there. Estella, how are you? I haven't seen you in a while. So in the chat, say yes or no. Do you currently prepare an annual budget for your business? Just yes or no, very quickly. Sherry says no. I'm surprised. Jen, yes, I know you're an overachiever, yeah, Jen. No, no golf. Yes, Jeff. Leslie, yes. So, gosh, it almost looks like 50-50. All right. Well, hopefully after today, maybe everyone will give it a try because it's super helpful. So again, I fell into all these different categories here when I've different parts of my career. You know, I had an issue with budgets because I felt like it was difficult to predict the future, especially on the revenue side. You know, but after doing tons of business plans and putting revenue projections in for a startup or something, you know, kind of got a feel for that now. So I don't feel so bad about that. It's, you know, you can do this. Often, you know, businesses, I was so busy, I neglected my finances, and I didn't have good financial information. If you don't have good financial information, then you can't have a good budget. And often I would start strong and kind of fall off over time. And then I thought I would outsource everything, my accounting and stuff in different instances, and had somebody else prepare my budget, which meant I didn't care and I didn't look at it. It was just like something to check off the box. So don't fall into these little traps here. You have to own this. So here's our 8 steps. If you have any questions or want me to stop and explain anything, or you think it's a dumb idea or whatever, just put it in the chat. I got it up. I'm keeping an eye on it. So here's our 8 steps. Step number 1, just like I mentioned, get accurate financial data. It's very important. So make sure your data is correct. So you might have to spend some time to go back through things, enter invoices or payments that we're hoping to get around to, just make sure that everything's up to date, ready to go, because you need this information to make decisions. If you have accounting software, make sure it's all up to date and accurate. Reconcile all outstanding transactions. You know, hopefully you're working with a bookkeeper that can help you get this all done. And then make sure your chart of accounts are set up correctly. Sometimes people want to get too granular with their chart of accounts, and so they have so many categories, it's hard to make decisions. So make sure that it's set up in a way that you can actually understand this and get information out of it. So this is where a bookkeeper can really help you. And then you need to own your financial information. You need to understand it and make sure it's accurate. You need to make sure it's accurate, and you need to understand it. It's very important that you do and review this on a regular basis. Step two, once we get everything in place, once we feel like everything's accurately entered and we're up to date, got a little check off from our bookkeeper, we need to review historical financial information, look for trends. So print out all the reports. So really we want to focus on what we did last year, but it's also very helpful to maybe look at 2 years prior, like have a 3-year trend in doing that. So I'm not going to dive into all that, but what I would recommend is that you make sure you have 3-year trend, so you can look at them side by side, and then trailing 12 months by month, so you can see any monthly trends and get understanding where you're trending on different things. So print out all your reports, your profit and loss, and your balance sheet. Make sure it's all accurate. Make sure you understand it. But in the budgeting process, we're going to kind of focus on the profit and loss statement right now. So what we want to do is print it out and go through it line by line, and then verify, every item with the bookkeeper or, a chart of accounts. And then once I understand it, I may want to customize it. And we'll talk about that in just a little bit. This is very helpful. So here is, the profit and loss statement for Dave's Decent Donuts. I don't know if you've heard of Dave's Decent Donuts, but they're not great, but they're decent. So here's basically, it's very simple, very, let's go through it. So we can just see, I'll get it up here so you guys can see it. So you can see, if I'm going to go through this line by line, I can see that we have total revenue for the period of $411,000. I do break it out, by the different sales categories, which you should do too. So, we had donut sales, which is the primary driver, 215, custom cakes, catering, and wholesale sales. We have our cost of goods sold, cost of sales, or cost, purchase of resale. So that means that to make all these products, I had to buy these, this amount of money. I had to spend this amount of money to buy products to make the donuts. That was 164,000, which means I left over my gross profit 246. And now everything else is just through, I'm going down, we had salaries and wages, rent. If I had printed out and shown you like 3 years, I could see whether some of these salary, for example, accounting, legal, maybe it was going up or maybe it was decreasing. So these are things I would need to know that I can only see if I'm following a trend. So after all that, we had a net profit of 36.6. Now in this instance, I had allowance for tax at 6,500, which means net profit after tax is this 30,000. But really what we want to focus on is pre-tax stuff, net profit before tax. Now, I can also dig in just a little bit more if I add this. If you have QuickBooks or most accounting software, this is checking a box where it will give you a percentage of total revenue. So if you look right here, you can see that our total revenue for the year of 411 is 100%. So everything feeds down into that. So, so for example, our wholesale sales were only 26% of our total sales. This is important stuff later on when you're making your budget decisions. The purchases for resale, our cost of goods sold, was 40%, which gives us a gross profit of 60%. So I like to think of percentages as dollars. So for every dollar I sold, it cost me 40 cents, and I get to keep 60 cents. And that 60 cents, that 60% is the amount that I'm going to use to pay all my other expenses. So that percentage is really important. And so you can see that of our expenses, salaries are Salaries and wages are by far our largest category. And when you're doing budgeting, you always want to start with the largest categories. And so we can see that we have a net profit of almost 9% here. Um, if I wanted to, I could access the Free Public Library. They have some databases there that I can see, like from a donut shop like mine, is roughly a 9% net profit before tax. Is that a good percent number? So maybe it is, maybe it isn't. But that that kind of gives you a little flavor of this. The percentages are important too, especially when we do the budgeting, because we want to use these numbers to kind of track our variable expenses. So now we reviewed our expenses, we reviewed our income, kind of understand our profit and loss statement. We have a good feel for it. Now, this was just mind-bending for me, but when I had this business that it had this weird contract, and the CPA said that even though the contract brought in money, had some expenses associated with it, the CPA said because of the way it was set up, I couldn't really show it as sales and expense. It had to show as a balance sheet item, as a payable, and then sort of a receivable that offset it. So what it actually did was throw a profitable business into a net profit because there was a loan associated with it. So that interest expense actually did go on the P&L. So it was this weird sort of thing. And so I had some partners in this deal, and they're going like, Dave, what's going on here? We're losing money month after month. And out of frustration, I called him up and I said, we're not losing money. This is just an accounting thing, and people are going crazy here. What can we do? And so he said, well, you're not locked into one view. You know, if you have accounting software, you can have multiple views and multiple report formats. And I'm like, cool, let's do it. So what we did was we reformatted so that it actually showed income and expense, and this whole contract thing, which I never could understand, just got off to the taxes and where it was supposed to be. So what you can do is you have what I called a business owner layout. You know, so I ended up rerouting things. You know, I can have multiple views, whatever what I was digging into, and you can save them, especially in QuickBooks, you can save them so you can just pull them up and see them. And it helps you show the true cost of things. And what I did was, after I figured this part out, well, let's just go through and change everything, you know. So I wanted to group things together to where I could make good decisions. And so I just changed it all. So let's take a quick look at here. And I just kind of cut this thing off a little bit because it gets pretty long. But so left the revenue sort of the same, but what I did was I recategorized our cost of sales. So I wanted to understand, you know, the cost of goods sold of the different sales categories. So we have the donut ingredients and the cake supplies, other things that, oh man, I misspelled delivery. Well, that sucks. I wanted to understand what these things, other things that we're going to go actually into sales. Like I wanted to recategorize things because often we put in expenses as things that are more or less a fixed expense where they really should be a variable expense, like in cost of goods sold. So, so shipping and delivery, let's say, you know, that's kind of a variable expense because unless I sell something, I'm not going to ship anything. So it's basically a cost of sale. So if I had a salesman, you know, salesperson selling donuts for wholesale, and he gets a commission on every wholesale account he sells, well, if I'm not selling anything, he's not selling anything, he does not get that commission. So it varies based on sales. So that's the whole concept. Variable expenses are those expenses that rise and fall with the rise and fall of your sales. Now, fixed expenses, everything else stays the same. So if I have $8 million in sales or zero sales, my rent is going to be my rent. It's basically fixed. So where you can make the most difference is in your cost of goods sold. Like, break out those categories. If you have five revenue generators in your income lines, make sure you have the same corresponding cost of goods sold, and then break those out as you're entering invoices and stuff like that. That gives you insight into where you're making money and what your best products are. Going down, I can categorize all these other things basically by grouping them together to make sense. So instead of just a broad, accounting, there's other things that kind of go in there. I can break out the wages or this office supplies, things that make sense. So I use this category, administration, to put all that in there. I could also break out things on advertising and marketing instead of just like a global advertising and marketing. I can look in there. I could understand things. Well, our website's costing us a huge amount of money, and our ad spends on Google way down. Maybe we should do something about that. Same with human resources. Now, when you have salaries and wages, when you have people, you can attribute some or all of their compensation into cost of goods sold also. That's kind of sometimes it's a hard thing to do, or think through, but that could be appropriate. So you can see that we just kind of broke these things out. It gives me a better detail for budgeting purposes. So from there, I can do the same thing that we did basically on the other simple spreadsheet. We can add our percentages, and so we can see that our cost of goods sold are, it's still basically the same, but we can look at the revenue drivers. So, even though custom cakes is only 15% of our total sales, it actually has a better cost of goods sold, a better gross profit, because the cost of goods sold is way less than the donuts. So maybe we should increase our cake sales somewhat. And then we can see all these percentages down here to understand how they affect us. So again, if we group things together, we can see human resources, our people is basically our biggest category, other than occupancy costs. We use that for budgeting. We need to understand those costs. So what do we do? How do we get this done? Well, what we just did is we dug in. We got the high level approach. We got the lay of the land. We have a good sense where things are going or trending. This is our starting point. So normally, if I was doing a budget, I would want to start with my revenue and then back into my expenses. But in this instance, and what I prefer to do is I want to start at the bottom. I want to start at net profit, and then operating expenses, then cost of goods sold, and then revenue. So if you think about it, I'm starting at the bottom of the P&L and then working up the sheet. And this has a lot of advantages, and I'll tell you why in just a second. So what we want to do is start with our profit. How much profit should we make? Now, profit is basically an equation. It is what's left over after our cost of goods sold, our gross profit, all the expenses, including your salary. Make sure you budget in your salary. And, I can, what is a reasonable profit? Profit really is a function of return on investment, and whatever your return parameters are, you could use that. But what I generally try to do is kind of aim a little high and see if it makes sense. Now, back to the benchmarking, when I mentioned that you could go to the library and access some of these databases. For example, if my business had a net profit of 3% and I see that the industry average of 12% is there, then that tells me I need to really look into my stuff, because I'm leaving about 9% profit on the table somewhere. So I really want to look into that. So um, so let's take just a quick gander here. So oh dear. So you can see, well, again, we're going to look at just net profit before taxes, 36,000 a year. And the percentage was, gosh, I forgot already, but it was about 9%. But I think that we can do much better than that. So we're going to start with that. So next we will go through our expenses and determine what's appropriate. Is there things that we can remove? Are there any one-time expenses that shouldn't be in there next year? For example, let's just say we got in a lawsuit and we had to hire an attorney to get through all this mess, and it was settled, and we're not going to have that expense next year. Well, that affects my profit and loss, so I want to pull that out. I want to kind of normalize it. So, or maybe I lost a couple employees, and so now I need to budget a decreased salaries and wages. So again, what we go through is we review any expenses line by line, um, and see if you can make any changes. This time of year, it's always a good time to maybe do some price shopping, compare things, especially like on insurance. I had this one insurance company that I had a great relationship with, and they were reasonable, and they were great guys. And I um, I forgot to really pay attention to what was going on, and I'd sold a couple trucks and forgot to tell them. So I was paying insurance for trucks I didn't even own anymore. So it's important to understand, what you're paying for, and kind of review everything. Here's where you also, most importantly, review your salary. So um, you're in business to make money. You're not in business to, feed this monster you created. So make sure that you can make a decent living out of this. Um, can you reclassify some of these things into cost of goods sold? So, for example, um, what I would recommend is, we have merchant fees down here. Merchant fees are like when someone buys, credit card purchase, the fee that the credit card company pays me, or that I have to pay the credit card company. That really, again, goes up and down based on sales. So it really is a variable expense. So maybe I should move that up in my cost of sales. Again, the shipping and delivery, and maybe I need to move that up there. So maybe some of the salaries and wages might need to be broken out. That's for you to decide. There's no exactly right way to do this. So some of these, like I said, utilities, can you change that? Marketing, software subscriptions, that's another good one, because I sign up for stuff all the time and then I forget that I did, and so I'm paying all this stuff, and um, that's something I would look into if you're anything like me. Um, Now, cost of goods sold. This is another one we want to really dig into. So we want anything that's directly related to generating revenue. So like I said, these are cost of goods sold is a variable expense. So if my sales go up and that expense goes up, then maybe I need to reclassify that into cost of goods sold. So are there ways that I can reduce this cost? Can I find a supplier that's a bit cheaper, um, and I don't spend as much? That'll bring my cost of goods sold percentage down. It's important to dig into this sort of stuff. So, um, Chris, hey Chris, how are you? Um, Yeah, I am suggesting that we break down, sorry, I wasn't watching this because I was too busy. Are you suggesting we break, Chris says, were you suggesting we break down the cost of goods sold for each revenue stream? And yeah, yes, that is exactly right. Um, Again, a quick example on our cost of goods sold is that each revenue driver, in our example here, our donut, our custom cakes, our catering, each one of them actually has a different cost of goods sold based on the expense, variable expenses associated with it. So by breaking them out, then you can see that, um, how they affect the global cost of goods sold. I've had some clients that I've worked with when we did this exercise, some of their revenue streams, they were actually losing money because their cost of goods sold were higher than what the revenue stream was. So that meant that either we had to eliminate that or we had to raise the prices to a decent amount. So, but if you're looking at just your cost of goods sold is 60%, 40%, that doesn't really tell you anything. It tells you that's what your global is, but you could probably improve that if you really kind of dug into that. So again, merchant and bank fees. Again, you may want to put those in there. So check that out. Now that we've done that, we have started at the bottom with our profit target. We have reviewed our operating expenses for the year, so we kind of have an idea what our expenses should be or what we're going to target. And then we have a target cost of goods sold percentage. And so now we need to figure out how much we want to make if we can hit this budget. So simple as this, how much net profit do we want to make? We estimated our operating expenses. We estimated our cost of goods sold. And now we need to determine our revenue target. So how do we do that? With this little tool here. And I'm going to back out of this, and then we're going to jump into the tool and look at this. There we go. All right. So again, this is a handy dandy fixed cost tool. So again, our variable cost is in our smaller example, we had purchase of resale for 40%. And then I went through all our different monthly fixed costs and our annual fixed costs. So accounting budgeted down a little bit, 7,000 or 500 a month, 583 a month. Advertising and marketing is 12. And so you can see that our monthly, well, gosh darn it. So what, let me back out of this. There we go. So currently, our monthly total fixed cost is 18,000 a month or 216,000 a year. So if you look back on our P&L, that's what it would have said. So, so using this as 216 expenses, what do we need to cover with our 40% cost of goods sold? So we do the calculation. If you look right here, our gross margin calculator, our total sales is 100% less our variable cost of 40% gives us 16%, 60% left over. And then we calculate our break even, which shows that our annual fixed costs for the year are 216 divided by our contribution margin of 60% means our break even was $360,000. And that means that our break-even sales for the month, for the year, and monthly is 30,000 or 6,900 a week or 1,000, basically 1,000 a day. That gives us our break-even to give us the profit that we showed our 9% profit on our initial thing. But we want to do a couple things. I want to budget in, I want to double my pre-tax profit from 36 to 72,000. And then I want to create an emergency fund just to have, just like Dave Ramsey, and I want one for my business. I want an emergency fund. So I want to budget 2,000 a month for that, or 24,000 a year. So that means I'm raising from 18 to 26,000 a month in our monthly. So you can see that our break-even sales went up to $520,000, or 43,000 a month. That's $13,000 more than the 30, or weekly 10,000, or daily 1444, which means I have to make 444 more dollars each day to cover these fixed costs. So now we know what our revenue target is, and it's just 520 is our revenue target. So let's jump back over here. So everybody understand what I just did there? Any questions or comments on that? I just kind of created a budget model based on my break even, using a break even calculator, baking in profit on top of the break even sales, and using that as my target. Does that make sense, everybody? All right. No questions. Oh dear. Chris, use assumptions when creating a budget. Yeah, I do. Again, it's because I use assumptions later. I can use assumptions, and they're kind of up to you. Basically, what I'm doing is I'm taking what I did and what I think a normal year would be, and I'm layering on top of that. First, I'm saying I want to make this much more money in profit, and I also want to have the emergency fund. I also want to pay myself something. So the 520 is right now is that number is what I came up with. Now, where the assumptions come in is like if I try to come up with different ways to do that, this is where we have to really think through. So, we came up with the revenue target. We subtracted from last year's revenue, and then that gives me the gap. If I can conceivably do what I did last year, I need to know what that gap is. And this is the question where you start putting assumptions in. Is that revenue target realistic? What strategies, or assumptions can I use to close that gap? Maybe I can't get there, maybe I can, but it's best to have that target and then work backwards from there. Yeah, Jim, it does make sense, but see, this is where we're at now. It's like, so these are the things I want. Now I have to come with strategies to close that gap. And it can go both ways. So let's just take a quick look. So my new revenue target is 520. Last year we did 411. That means I have to generate $109,000 more. So I can do it two ways, basically. I can do it by increasing sales. I can also do it by flexing my expenses, especially on cost of goods sold. And that's why I break out the cost of goods sold per revenue driver, because that will help me understand, are there goods and services that maybe I shouldn't do anymore? Maybe I'm not pricing right, so these are different things, but yeah, you always have to have a target and then work for expenses. Look for strategies to get to that. So also, in addition, the other part of this that I've kind of forgot sometimes, like, if you're selling more, the more your cost of goods sold is. Revenue costs you money. It costs money. So unless you have the cash or the credit to fund the sales, that's the other part of this thing. You might not be able to afford to grow, but um, so also review staff and all these other resources. I just make sure that if you can, we're looking for $109,000, to fall to the bottom line, or not fall, to grow our revenue. What are those resources that we need? Do we need more staff or any of those things? And then finalize your budget. If you think you can do what you do, the revenue by using, growth strategies or reducing expenses, put that budget into your accounting software. So when you pull your reports, um, I would um, I would have the percentage, I would have the percentage of for actual, so I can see that. I would have actual to budget, and so the budget and then actual. So this is a good way to kind of track your trends, make sure you're on budget, and if not, kind of gives you an alarm where you can dig in to um, dig in to whatever it is. Maybe you're behind in sales, maybe you're spending too much money, whatever it is. But this is something you really need to look at monthly at the very least. That's why I like to use my break-even spreadsheet, so I know what I need from my revenue target is, weekly and daily. That gives me, up to the minute, basically, um, um, whether I'm hitting it or not. So here's some helpful tools. If I were you, I'd take out my camera and I would just um, take a picture of these. These are some great websites that have some great budgeting tools, spreadsheets in there that you can download. And I'll just hang here for just a second. And then that's about it. I know we kind of went through this fast, and so the good news is everybody will get a copy of this recording, and I'll send you also the break-even spreadsheet too, so that you can use that as part of your budgeting process. But if you hover over this QR code, you can jump on my calendar. We can work together on your calendar, on your budget if you like. This is a great time to do it, and just bring a couple years financials. We can just start from scratch, put it all together if you like. Always happy to hear from you guys. And then, like I said, we'll send this to you. It'll be up on our YouTube channel, so make sure you check that. We got a ton of stuff up there. Why don't you subscribe to our channel? I think we have about almost 400 different experts and webinars and resources on there. So check that out. But like I said, if you'd like to work together on that, I'd be happy to help you out, and we can talk about it just on the on a Zoom call. Any other questions or comments? You've been surprisingly quiet, except for Chris. Chris is one of our colleagues at the Urban League. He's always on my back about something, but that's okay. Why says thank you. Yeah, thank you. Right, Chris. Um, so yeah, it's great having you guys. Again, I don't know. Hopefully, I personally love all this financial stuff. It's fun for me, not fun for everybody I hear, but so let's see. Katie, hey Katie, you mentioned about the cost to bring in revenue. How do you balance trimming expenses versus increasing revenue? Um, So the there's kind of another concept of budgeting that um, this is a whole nother webinar, but the idea of flex flow budgets. Um, so when you increase revenue, um, if I were to recast my profit and loss, so some of those things go into my cost of goods sold, then I can see where I would need to, basically flex out to pay for that. Um, some of the other things, the non-variable things, there might not be anything I could do about that. So that's why it's important to understand your cost of goods sold, and understand that, how to finance those things. So some of those projections um, are important to do. So I don't know. It's best if we kind of look at it line by line. So maybe we could jump on a call. We can kind of go over that a little bit more. Um, let's see, Pruitt. There we go. When it comes to increasing revenue, is it better to cash flow or use a line of credit to pay salespeople? Again, if you have the cash, it's best to do that yourself. Um, a line of credit is important, especially if you're doing big ticket items. That's good. What I prefer though is, let's just say, and it's becoming more and more common. What we don't want to do is turn ourselves into a bank to our customers. So, customer says, I want to buy your stuff. And then because of the way I've set up my terms, they don't have to pay me for a month, maybe like 30 days, like 30 days credit. So we want to make sure that we get paid right away or in advance before we even order. So especially if I'm doing products, um, where instead of having an inventory on hand, I had to pay for that, and now it's sitting there and it's money on a shelf that I can't spend. So if I can figure out a way to work with just in time with the supplier where I get an order, I place the order with my supplier, I get the money from my customer right away, I pay my supplier, so it's a quick cash cycle. Again, it's a juggling act. There's no one way to do it. You just have to kind of figure out what works best for you. Um, okay. Jim says, I think it's intimidating without the background general ledger info, decisions to categorize too minutely versus generally. Yeah. But see, Jim, that's what I was saying about the multiple views. I think that's why it's really helpful to have multiple financial views saved in your QuickBooks based on what you're doing. Really, what you need is the information, not the layout. So um, if you need the background information, then by all means do. It's your information. You needed to make decisions, not make it look right or to someone else. So that's what I would do. I mean, on my QuickBooks, I have 4 or 5 different formats saved based on what I'm doing and what I'm using it for. So that's basically my message there. Maybe I didn't make that clear, so I apologize for that. So yeah, hope that clears things up. Um, yeah, but again, you know, budgets are like business plans. They they change at the first meeting of a customer or a business. So you're it's just kind of a starting point to kind of get you where you want to go. We're trying to guess what the end state's going to look like and how we'll get there. It's the model we're going to use to get there. Doesn't mean that actually we go that way, but 9 times out of 10, when you have a budget, you'll probably hit it. So again, if you want to work with me on your budget, I'd be happy to help you. It's fun for me, so you're not putting me out for anything. And again, We are a free service, so. Looks like, don't see any other questions. All right, folks, that wraps up another Toolkit Tuesday. So thanks for showing up today. I know you had other things to do and you chose to spend your time with me, so I really do appreciate that. But, if you found this helpful, hope you did, jump on our calendars. We're here to help. You can schedule a one-on meeting with me or any of our business coaches anytime. There's no cost or catch. It's pretty easy. You'll be able to see our calendars. You pick a day and time that works for you. You don't have to call and go back and forth with calendar invites. Just schedule and we'll be there waiting for you, So we can help you build or refine your business plan, prep financials and loan applications. We're pretty daggone good about finding money for companies and entrepreneurs, so check that out. But, we can just help brainstorm, your next smart move or your budget even. So check us out at KentuckySBDC.com/Louisville. You can email or jump on our calendar. So thanks again for joining us today, and be sure to check out, look for your email for other upcoming Toolkit Tuesday and your replay and these some files and stuff. So hope to see you soon. We'll see you next time on Toolkit Tuesday. Janet, thanks for driving the ship as always.
Thanks for being our expert today, Dave.
All right. Thanks, everybody, for joining, and we'll see you next Tuesday. Bye.